Today, I'm going to be having a look at index funds. This is primarily what Goodfruit Investors sees as beneficial for a good majority of people that are researching and looking at investments. And there's a lot of really good, solid research behind it. One of the most interesting pieces of research, we're going to look at that today. And it really ties into why index funds have been able to build traction and why people are actually wanting to get into it. Because if you really think about what an index fund is, it's essentially just a huge package of all of these various stocks, all of these different types of investments, and they're usually catered in a way where they're based on market capitalization. So they're wanting to look at the performance of a whole indices. So when you look at something like, the U.S. stock market, a lot of people refer to something like the S&P 500, which is 500 of the largest stocks, which makes up the majority of the market share in the States. And so when people invest in those types of stocks, they're essentially investing in the market as a whole. Where if someone wanted to invest in Canada, there's the TSX, there's an index for that. If people are wanting to be diversified across the whole global index of stocks and investments that are out there, there's an index for that. And so the question really is, why would somebody want to put their money into the stocks? Like, wouldn't financial advisors or, maybe like myself, like when I first got started, I thought, okay, I really want to get into investing. And so as a result of wanting to get into investing, you don't want to just get into anything and something that's just mediocre. You want it to grow. You want your investments to have a very high potential of succeeding. So you do a bit of research, digging into a bunch of stuff, and really start figuring out what to invest into. Where a lot of times what I find that a lot of people do is they'll just start picking different stocks that they want to pick because they think those stocks are going to go up for whatever reason. Or maybe they're listening to a financial advisor that's selling them some kind of product and saying that, they've had a really awesome track record. And so then, you want to be invested in things that are actually going to actually have that huge growth. Nobody wants to be invested in something that's mediocre. So a lot of times what happens when you hear the word that index investing is that you think, oh, okay, well, it's just probably going to be average. So it's probably going to be middle of the road, right? Like, you might find that, 50% of investors are surpassing it, or 60% of investors are surpassing the index, but people just invest in the index because that's what they invest into. That seems to be sort of like maybe somebody who's new to the industry and looking at it might be what they think when they first, are making guesses. Or, what are your guesses? Leave a comment in the comments down below as to what you think are the percentages, because we're actually going to dig into what the research says over this. There's lots of different types of research that is out there. But one of the pieces of research that I really want to dig into is called the SPIVA Scorecard. Now, research is really important because there's lots of different levels of research. If you get into something like a case study is a lower level of research. So if you've gone to university and studied, research methodologies, like I've done that, you find out things like meta-analysis are way up at the top. And so, whenever I'm looking at a piece of research, I'm always asking myself the question, where does this fall in the spectrum of relevance? And how much data are they accumulating? And this one piece of data accumulates a ton of data. So don't be confused as to, the simplicity of how it's actually laid out. It's done that so that, it can show to the majority of people that are out there. But just know that there's a lot of data behind it. So I'm going to share my screen here. So you can see here, this right here, it comes from S&P Global. It's called the SPIVA Scorecard. And what this does is it's looking at all of the data against actively managed funds versus index benchmarks. And so this is really important to look at, because if you look at something like the US market, you look at it over the course of, say, 15 years, which is a lot of data that they've had to accumulate in order to get that. 15 years. And there's a lot of, really a lot of different, you know, different types of investments that they would have to pull from in order to grab that. So you can see here, you know, you've got, 89%, and this, by way, is not the investors that are actively trading. This is the indices. This is the indices. So I'm going to go back. So this is the indices here of just simply taking on the index. Like you're not you're not doing anything different. And this is the interesting thing. If I look at something like over a course of a year, you can see that the percentage is a lot different. So you can see that it's only 21% of the of funds outperform the S&P 500. So you might have a higher percentage threshold. And I've looked at this over the course of a few years, and it actually is quite higher. So it might be higher if I go to the 3. Yeah, it is. Because in some years, the general consensus of investment firms out there, they may get it. And so they might beat the market over the course of a short duration of time. And the reason why that's important to note is because when you're looking at these various time frames and you're breaking them down and seeing, okay, well, how does something like this investment, this investment company, how are they going to, where are they going to put my dollars? What are they going to do with them? How are they going to actively trade? And, they're going to probably cherry pick, their best years, or, pick the range of years that's going to showcase, what they're doing well and how they're beating those benchmarks. But in general terms, over the course of a longer period of time, most types of actively managed funds are not performing better than just simply holding the indices. Now, if I was, looking at a test and I was trying to study something, and I was looking at, okay, what is the percentage that I'm going to succeed at this? And, if I looked at, okay, if I am I going to pick that 10%? Am I going to get, in that 10% range where, those are the investments that I'm going to, that I'm going to actually reap the rewards from? Or is it going to be more like the 90%? And so I would rather side on the side of the 90% rather than the 10%. And the question that I would have for myself too is, if I'm invested in that 10%, how successful or how much better are they than the indices? And, it would have to be some astronomical amount of returns in order for me to take on something of that risk profile to say, okay, yeah, you know what? I'm going to invest in, this actively managed fund managed by this bank. Like, I'm going to invest in that. That's what I would have to do. I'd have to see, like, the returns have to be would have to be super juicy to take on an element of risk where, I can see that they usually underperform. And past performance doesn't necessarily indicate what your future performance is going to be. And that's why they are wanting to grab that data from so many years. And so at Good Fruit Investors, what we do is we look at, okay, if we're wanting to invest in indices, if we're wanting to invest in something that has a higher probability of success, how do we go about doing that? Like, what are the ratios and ways that people invest in these indices? Like, should I invest in something like all international stocks, or should I invest in, the S&P 500 for the US stocks? So there's lots of different ways on how to be able to assess that. And one of the interesting things, again, for me, as to even why I wanted to start something like Good Fruit Investors, was because of seeing this kind of data, seeing this kind of research and this kind of information, and realizing that there's a lot of ways that people can manage investments themselves and really minimize a lot of fees and get themselves into having really healthy investments. I want to show you one more thing here from this scorecard. I actually want to go to the Canadian one because I'm actually from Canada. And so when I looked at these numbers, I was shocked. Not only are we looking at 10%, for the States over 15 years, we don't have 15 years yet for Canada, but we can see here 1.18% of funds outperform the S&P 500 composite. I have a lot of questions for actively managed funds here in Canada. Um, Again, you have to look at what data it's pulling, how it's pulling that data, which indices it's comparing it to. So we're looking at specifically Canada, where I feel like a lot of people, when they're invested, they're usually invested in a lot of the what's invested in the States. Even Canadians, a lot of Canadians have a lot of different investments in the States. But it still begs the question, if you're getting a 1% success rate, like 1%, is it worthwhile? And I would say I don't care how big the returns are. I don't care if it's just one firm that's just done super awesome and super amazing. There's way too big of a risk in my mind. And so again, do your own research. This isn't financial advice. Just trying to, broadcast research and information that's out there so that people have a better understanding of how to invest and how to stay competent in this area. So if you like this video, subscribe and stay connected with more videos that are coming out from Good Fruit Investors. See you in the next video.